Today, we are diving deep into a financial explainer of an absolute giant, India's very own life insurance corporation, or LIC. Everyone is asking the exact same question right now. Is this stock a massive long-term value trap, or are we looking at one of the most undervalued opportunities in the entire Indian market? Well, we're going to let the numbers do the talking and find out the real truth. Think about this for a second. LIC alone manages more assets than the entire Indian mutual fund industry combined. It's mind-blowing. Yet ever since its IPO, the stock has left a lot of investors feeling, well, pretty underwhelmed. So why did this happen? Honestly, it boils down to the IPO pricing. When it listed, LIC's massive market share and asset base were already fully priced in by the markets. There wasn't really any room left for cheap future growth. But the big question is, has that narrative finally started to shift? To get to the bottom of this, we're going to conduct a strict forensic audit today. We'll quickly break down their business model and moats, compare them head-to-head with private insurers, analyze their financial growth, dig into their asset quality, and finally, weigh the risks against their current valuation. All right, let's jump right into Section 1, Understanding LIC's Business Model and Their Economic Moat. Before we get into the heavy lifting, we need to set a ground rule for analyzing insurance companies. You've got to throw your traditional PE ratios and EPS growth out the window for a second. In the insurance world, two metrics rule them all: EV and VNB. Embedded value, or EV, is basically the company's current net worth plus the present value of all its future profits. It's what the future cash flows are worth today. And value of new business, or VNB, that simply tells us how much profit was actually created from the brand new policies sold this year. Trust me, these two numbers are the absolute holy grail of insurance valuation. Now, just look at this absolutely gigantic number, 57.29 lakh crore rupees. That is LIC's projected asset under management for FY26. I mean, it's almost hard to wrap your head around, right? This figure is absolutely crucial because it highlights LIC's unparalleled moat. They essentially have a massive chunk of the entire Indian economy parked right in their vaults, making it practically impossible for new players to come in and disrupt them on sheer scale. Moving on to Section 2. To really understand what's happening despite that massive scale, we have to see how LIC stacks up against the private insurers. And let me tell you, the competition here is fierce. Agile private players like HDFC Life, SBI Life, and ICICI Pru have been aggressively eating into the market share over the years. Historically, these private insurers command way higher VNB margins and just grow faster. Plus, their customer persistency ratio, which is just a fancy way of saying how many people actually keep paying their premiums year after year, is super strong. Because LIC relies so heavily on older legacy products, they usually get a slightly lower qualitative ranking compared to these nimble private giants. But here's where things get really interesting. The game is changing. The old LIC relied entirely on a traditional agency model. It was all about pushing high volumes of low-margin participating products. But now, we are seeing a massive strategic pivot. Management is hyper-focused on margins. They are pushing high-margin protection products and non-par policies like never before. And the real game changer? They just crossed a huge 5,000 crore rupee premium milestone strictly through bank assurance, meaning selling through banks. That is a massive shift for them. Let's roll into Section 3, Financial and Growth Analysis. A new strategy sounds great on paper, but are the actual numbers backing up this turnaround story? If we track the trend over the last 3 years, LIC has shown a seriously strong bounce back in both revenue and profit. After a few years of post-IPO struggles, looking ahead, their profit after tax for FY25 is expected to hit around 48,151 crore rupees. In fast forward to FY26, that profit is projected to jump to a staggering 57,419 crore rupees. That's a fantastic 19.25% growth in their bottom line. Plus, their total premium income is growing at a very steady, healthy pace. The real engine driving this turnaround is their shifting product mix. In their individual business segment, the share of non-par products has actually crossed the 35% mark. Why does that matter? Because these are the highly profitable products where guaranteed returns to the customer are lower, and the profit margins for the company are much, much higher. This is the exact lever LIC's management is pulling to drastically improve that bottom line. And you can see the direct impact of this strategy on their profitability. Management had given clear guidance for the next 3 years that they wanted to gradually push their VNB margins past a 20% target. But honestly, the turnaround is happening so fast
that the FY26 estimates show their net VNB margin is already hitting 21.2%. Beating their own growth guidance and pushing margins that high, that quickly, is incredibly impressive. All right, on to Section 4, asset quality and investments. We know they collect billions in premiums, but what exactly is LIC doing with all that cash?
So, in the insurance sector, asset quality means something completely different than it does for banks. Here, it's all about the quality of their investments. And LIC, they sit on a massive equity portfolio packed with blue chip stocks like Reliance, ITC, and SBI, holding huge hidden embedded gains. On the flip side, their debt portfolio is incredibly safe, parked mostly in government and PSU bonds. Across this entire portfolio, they're generating a really solid yield of 8.92% for FY26. This is a fortress-like strength that their rivals simply can't match. Moving right along to Section 5, forensic analysis and risks. The most critical part of any deep dive is stripping away the hype and looking at the cold, hard truth.
Let's start with the green flags. The biggest sigh of relief is their FY26 solvency ratio, which sits at a highly safe 2.35. In the insurance world, the solvency ratio is your ultimate safety net against crises, and 2.35 is excellent. Another huge positive is their massive cash generation. They actually just paid out a 59,726 crore rupee bonus to policyholders. And a third green flag, the one the market was really waiting for, a booming VNB growth of over 41%.
But we've got to keep it real and address the yellow and red flags too. First up, their market share is still gradually slipping as private peers aggressively expand. The second major caution is government influence. Because LIC is a public sector undertaking, the market naturally applies a discount due to risks around capital allocation and strategic decisions. And finally, even though new products are doing well, over 60% of their revenue is still tied up in those low-margin, legacy traditional policies. Now that we've laid out all the evidence, it's time for the final piece of the puzzle. Section 6, market cap and valuation. Let's look at the FY26 valuation metrics. Their embedded value is projected at almost 7.89 lakh crore rupees. They're trading at a PE ratio of just 9.2 and a price to book of 2.9. Now, if we look at the PEG ratio, that's price to earnings growth, things get really interesting. With that low PE and an aggressive 19% profit growth over the last few years, their PEG ratio drops to around 1 or even lower, which is a classic signal of being deeply undervalued. But remember, we buy insurance stocks for EV growth and future cash flows, not just cheap current earnings. And all of these metrics culminate in this current market cap figure, 528,960 crore rupees. Backing up this massive valuation is a company generating an astounding 57,419 crore rupees in net profit in a single year. It purely illustrates the sheer financial gravity of this corporation. This is a sleeping giant that is finally waking up and changing its old ways. So after breaking all of this down, I want to leave you with one provocative thought. We have a mega corporation with soaring VNB margins, making a massive, successful push into bancassurance and non-par products, and directly taking the fight to its private competitors. Is it finally time for the market to drop that stubborn government ownership discount? Does LIC's fundamental turnaround make it the biggest undervalued opportunity in India today? I'll let you be the judge of that. I hope this explainer gave you a whole new perspective. Keep learning.